Hey there, and welcome to the Market Access. Today we will talk about the 5 most common securities you must know: stocks, bonds, mutual funds, ETFs, and Forex currencies. I will briefly describe the mentioned securities, I will tell you how they work, and finally, why would someone invest in them? Let's get right into it. Stocks. The first security we will talk about are stocks, which are most likely the most famous financial instrument worldwide. What are stocks? Stocks are pieces of ownership of a certain corporation. Therefore, when you buy a stock, you buy yourself a piece of a company. You then own a very small part of said company. Stocks are publicly traded on specific markets that are called stock markets. Some of the biggest and most known stock markets are the New York Stock Exchange, and then the largest Asian stock market, which is the JPX, or the Japan Exchange Group based in Tokyo, and the largest European stock market, which is the LSE, or the London Stock Exchange. The most famous Italian stock index is the FTSE MIB, based in Milan. This index contains the 40 largest Italian companies. Now, why would someone buy stocks? There are many reasons to invest in stocks, but the main reasons are 3. The first one, you want to own a piece of a corporation because you believe in its values and what the corporation actually does. The second one, you want to bet on the company's rising value. And the third one, you want to buy a solid corporation stock which offers you dividends. So in the first case, I buy a company stock because I share the company's core values and ideas, and I truly believe in the company's work. But the truth is that most people decide to invest in stocks because they expect to gain money by buying a certain stock at a determined price and selling it at a higher price, therefore betting on the company's ability to conduct business. For instance, I buy a stock at 15 and I sell it at 20 with a $5 profit. This is the main reason people invest in stocks. The third option is to invest in a stock without worrying about the changing price of the stock itself, because we are mainly focused on the dividends the company pays out. Therefore, I buy a certain amount of stock because I know that that corporation will pay out dividends to its shareholders. For instance, I buy 500 shares of a corporation that pays out a dividend of $1.50. This means that each year I will receive $750. Bonds. Bonds are basically loans we give to a company, or more frequently to a country. When we buy a bond, we basically lend our money to a country that will return that money back to us when the loan ends. The technical term is when the bond matures. In exchange for the money we lend to the government itself will pay us interest on it. The main Italian market where government bonds are bought and sold is the MOT. The main reason to invest in bonds is to park our money for a certain amount of time, and in return we receive an interest on that parked money, which in this case is called coupon. For example, I buy a 3% fixed rate bond that will mature in 5 years, and its value is set at $1,000. So each year for 5 years, I will receive $30 on my account, and after 5 years go by, I will receive those $1,000 I initially invested. This is a very simplistic example of how a fixed rate bond works. If you want to invest in bonds, I suggest you study up all the different types of bonds available. If you would like to watch an introductory video on bonds, I will put a link in the description for you. Mutual funds. Mutual funds are like a piggy bank where a large number of small investors put their money. Mutual funds are usually managed by the fund manager, which decides in which securities to invest all of the money in the fund. Funds invest in many types of securities, ranging from stocks to bonds and even shares of other mutual funds. Now, why would someone invest in a mutual fund? One of the main reasons to invest in a mutual fund is that the investor wants to delegate the investment strategy and choices to a professional whose job is exactly to do that. When buying a mutual fund, you give your money to someone to invest it for you and to manage that investment. You do not have to worry about buying and selling certain securities when the time is right. There is someone who will do that for you. Obviously, if someone else does all the heavy lifting for you, you must pay them off, and that's why mutual funds usually have high managing costs. Here's an example. Let's say you work in the IT sector and you want to invest your money in that sector without being too specific about the companies. You tell your broker you want to invest in a sector fund, specifically the IT sector. The fund's value is expressed with the NAV, or the net asset value, which changes only at the end of the trading day. The main reason to invest in the mutual fund is to buy its shares at a certain price and to sell them at the higher price, much like you do with stocks, to profit from that transaction. ETFs. Exchange traded funds are investment funds which are traded just like stocks are. Basically, ETFs are large baskets of many different stocks that are sold as one. This means that when you buy one share of a certain ETF, you invest in many different corporations. Generally speaking, ETFs are meant to recreate or to mimic a certain index, such as the S&P 500 or NASDAQ. They do that by investing in the companies that trade on those indexes. Therefore, the purpose of an ETF is to replicate the return of a certain index. Now, why would someone buy an ETF? Investing in an ETF means investing in a security that should replicate a certain market. If an investor believes that, for example, Italy will go through an economic boom in the next few years, we can invest in the whole Italian market through an ETF whose benchmark is the Italian stock market. Otherwise, you would have to cherry pick every single stock of every company to create an investing portfolio based on the Italian market. Yet again, we buy these securities to gain from the change in its price. You buy one ETF share at 100 and after 1 year you sell it at 105, taking a $5 profit. The Forex currencies. The last financial instrument you must know are currencies. Currencies were obviously not invented to be a security in which to invest. However, as the world and its economics evolved, so did currency's purpose. We created a market where investors can trade currencies and profit off the change rate fluctuations. The most effective way to explain this process is with an example. So we open up our Forex page. Forex is the foreign exchange market, or the monetary market. And we see that euros and British pounds trade up at 0.79 to buy and 0.77 to sell. This means that with 1 euro I can buy 0.79 pounds. However, if I decide to sell my euro to someone who will buy it in pounds, I will receive only 0.77 pounds. Now, I borrow 79,000 pounds from a broker and I sell them to an investor who wants to buy them in euros. This means that for my 79,000 pounds, the investor will give me 100,000 euros. After a while, the exchange rate changes, and now the euro selling price is at 0.81 pounds. This means that if someone wants to buy my 100,000 euros and wants to pay in pounds, he will have to pay me 81,000 pounds. We finalized the deal, and now I have 81,000 pounds on my account. Now I return the money I borrowed from the broker, which was 79,000 pounds, and I pocket a profit of 2,000 pounds. So there you see, why should someone invest in the Forex market? To be honest, there are many reasons to do that, but the two main ones are: one, reduce the exchange rate risk, and the second one is to profit from the exchange rate fluctuations. The second option is quite understandable. I buy a currency at a low price and I sell it at a higher price to profit from the transaction. But when it comes to reducing exchange rate risk, there's a whole new world that opens up, and I will tell you all about it in the financial risks video that will soon be available. Alright, these are the 5 securities you must know. Thanks for watching, and remember to give this video a thumbs up and subscribe to the channel to see the next videos. Alright, I'll see you next time.